In 1951, a coal miner in Pennsylvania filed his federal return and legally owed Washington nothing. Zero. The IRS reviewed every line, approved it. His method is number 7 on this list, and anyone with a W-2 can still use part of it today. Number 14 was taught in public schools until 1971, then vanished from every curriculum without a single explanation. Number 1 was removed without a congressional vote. Before we continue, subscribe. What follows took accountants decades to quietly stop teaching on purpose. Number 20. The Home Office deduction before Washington complicated it. Before 1976, running any business from home meant one simple thing at tax time. You deducted a portion of your housing cost directly from taxable income. No photographs required. No exclusive use tests. No audit threats waiting for families who dared claim it. A salesman in 1953 stored samples in his spare bedroom and wrote off 20% of his rent every single year. Legal. Never questioned. After 1976, the space had to be used exclusively for business. A shared room no longer counted. Families watched their bills climb by hundreds, not because their lives changed, but because Washington decided they should. Number 19, every dollar of interest you paid, fully deductible. Before 1986, interest was interest. Car loans, furniture financing, store payment plans, department store accounts. Every dollar of interest reduced your taxable income automatically. No accountant required. No special forms filed. A working family in 1964 carrying a car payment and a refrigerator loan deducted interest from both without a single professional consultation. Your grandfather learned this from his barber. His brother confirmed it. Common knowledge, because it applied to anyone paying interest on anything at all. The Tax Reform Act of 1986 removed personal interest deductions entirely. Only mortgage interest survived. Lenders never publicly complained. They had absolutely no reason to. Number 18, averaging a good year so it did not destroy you. Before 1986, a strong harvest never meant a punishing tax bill. Farmers averaged their income across 3 previous years and paid tax on that number, not the spike that arrived from one exceptional season. A corn grower in Indiana, whose 1957 harvest tripled his normal yield, did not pay triple the tax. He spread it backward, kept the difference, and bought the adjacent field he had been watching for 3 years. This protection extended beyond large farms. Anyone with a seasonal produce, stand, or rural income stream qualified. Millions of working families used it for decades without fully understanding how valuable it was, until Congress removed it quietly in 1986. Number 17. Sick pay the government once agreed to leave alone. Before 1976, employer sick pay came with a tax exclusion, built directly into the code. If illness kept you from working and your employer continued your salary, a meaningful portion of those payments was excluded from federal taxation entirely. A steelworker in Pittsburgh who broke his arm in 1961 and received 8 weeks of paid leave owed taxes on only a fraction of it. Washington recognized that replacing lost wages during illness differed fundamentally from earning a raise. Congress phased the exclusion out between 1976 and 1983. Today, every dollar of sick pay is fully taxable from the first hour. Your grandfather called that arrangement indecent. Looking at the numbers, it is hard to argue otherwise. If this list is landing differently than expected, subscribe right now. Number 7 changes how you think about every April you have ever filed. Do not miss it. Number 16. Relocating for work without funding it yourself. Through most of the 20th century, moving for a job meant the tax code shared the cost. Truck rental, temporary housing, travel expenses, meals during transit, all fully deductible. No income ceiling applied. No employer reimbursement required. First, a factory worker transferred from Cleveland to Detroit in 1967 deducted every dollar that relocation cost him. The code recognized a simple reality. Moving toward available work cost real money that working families deserve genuine relief from. Assembly line workers used this. Nurses used it. Teachers and retail managers used it for decades without complication or question. The Tax Cuts and Jobs Act of 2017 suspended the deduction for most Americans entirely. A worker who relocates today funds every mile from already taxed income. Number 15. The first $100 of dividends. Completely untouched from 1954 to 1986. Every American who owned stock excluded the first $100 of dividend income from federal taxation automatically. Couples filing jointly received $200 excluded. No forms, no conditions, no phase-outs applied. In 1960, $100 in dividends represented a real position in AT&T or General Electric. Working-class investors who bought shares steadily paid no federal tax on their earliest returns. The government treated small investors as participants worth encouraging. Congress ended the dividend exclusion in 1986. Same act, same session as numbers 18, 19, and 20 on this list. 4 protections removed in 1 year, not one replaced. Families simply paid more the following April and assumed that was how it had always been. It had not. The deductions removed so far were not complicated. Ordinary Americans claimed them at kitchen tables using nothing more than a pencil, a W-2, and knowledge passed down the same way recipes were. What follows is where that knowledge became something Washington found genuinely inconvenient to leave in place. Number 14. Income averaging for anyone who ever had one good year. In 1954, Congress extended income averaging to every American taxpayer. Any worker whose income significantly exceeded their 4-year average could spread that spike across all 5 years and pay taxes on the average, not the peak. A carpenter in Ohio who doubled his normal earnings in 1963 did not pay double the tax. He averaged it back, kept the surplus, and paid his daughter's first year of tuition with it. Commission salespeople use this every year. Teachers who worked summers used it. Small business owners whose best year finally arrived after 3 difficult ones used it. Congress eliminated it in 1986. Same act. You already know which one. When a single session removes home offices, personal interest, agricultural averaging, dividend exclusions, sick pay, and income averaging simultaneously, that is not simplification. That is a verdict about whose money the code was written to protect. Number 13. Disaster losses without waiting for federal permission. Before the 1980s, if fire, flood, storm, or theft struck your property, you deducted the uninsured loss from taxable income that year. No federal disaster declaration required first. No minimum threshold to cross before claiming. If you lost it, you wrote it off. A family in Missouri whose home flooded in 1971 deducted the full uninsured damage from their federal return. Washington shared in their loss exactly the way it shared in their income every other year. Today, the loss must exceed 10% of adjusted gross income and applies only to federally declared disasters. A family rebuilding after a fire in an undeclared county pays full taxes on every dollar earned while starting from nothing. Number 12. The capital gains break built for people who built things slowly. Before 1987, selling a small business built over decades meant excluding a meaningful share of those gains from taxation. The reasoning was direct. 30 years of labor deserved different treatment than a financial transaction completed in an afternoon. A hardware store owner who opened in 1946 and sold in 1979 for $80,000 above his original cost did not owe tax on all of it. The code distinguished between building something slowly and profiting from something quickly. The exclusion narrowed through the late 1980s and disappeared for most small business categories within years of the 1986 Act passing. Today, a family that sells a business after 40 years of work pays the same capital gains rate as someone who held a stock position for 13 months. That decision was made deliberately in writing. by people who understood precisely what they were changing. Every deduction on this list was written by Congress for working Americans, not for corporations. Not for corporations. Not for inherited wealth. For people who earned wages, built small things, raised families, and filed their own returns at the kitchen table every April. Each removal was also a choice. Made deliberately, justified as simplification, felt by millions as something else entirely. What follows is where those choices become impossible to excuse. Number 11. Retirement deductions that once covered the spouse who stayed home when individual retirement accounts were introduced in the early 1970s. A married couple where one spouse worked and one stayed home could contribute to accounts for both and deduct both contributions from taxable income in the same year. A single-income household earning $14,000 in 1977 sheltered $3,000 from federal taxation entirely through a simple provision written specifically for families who needed shelter. Most income limits arrived through the mid-1980s. Phase-outs followed. The deductibility, the part that made the account valuable for families who actually needed it, was restricted until most middle-class households stopped qualifying fully. The account still exists. The protection it once carried does not. Number 10. Dependent care before the government made it a maze. In the 1950s, paying someone to care for your children while you worked reduced your taxable income directly. No income ceiling existed. No documentation requirements applied. No provider identification numbers were demanded from the neighbor watching your children on weekday afternoons. The system assumed working parents had genuine costs deserving genuine recognition and treated them accordingly. By the late 1970s, income caps arrived. Then phase-outs. Then paperwork specific enough that families who had used the credit for 15 years quietly stopped claiming it, not because they no longer qualified, but because navigating it alone became impossible. Complexity is never accidental. It is always a decision someone made on purpose. Number 9. Work expenses that once reduced what you actually owed. Through the 1980s, unreimbursed employee expenses were fully deductible against ordinary income. Union dues, personal tools, required uniforms. Job-related travel your employer declined to cover. Every dollar spent doing your job reduced your taxable income by that exact dollar. A nurse who bought her own supplies. A carpenter who replaced his own blades between jobs. A salesman driving 4 states on his own gas money without reimbursement. All of them recovered something from Washington each April, legally, automatically, without complication. The Tax Cuts and Jobs Act of 2017 eliminated unreimbursed employee expense deductions for every W-2 worker in America. Every tool a tradesman now buys comes from income already taxed in full. Every license renewal. Every required uniform. Every mile driven without reimbursement. Number 8. Business loss carrybacks that return real money. Before restrictions arrived through the late 1990s, a small business owner who suffered a devastating year could carry that loss backward, applying it against taxes already paid in profitable years and receiving an actual refund check. A plumber in Ohio with 3 strong years followed by 1 catastrophic year in 1974 recovered cash he had already sent to Washington. The government shared in his success during good years. It shared in his hardship when hardship arrived. Carryback provisions were steadily restricted through the 1990s and eliminated for most small businesses by the 2010s. Losses now carry forward only, meaning a struggling owner receives no immediate relief while current obligations continue regardless of what the previous year cost him. Number 7. The investment credit that rewarded businesses for growing. From 1962 to 1986, purchasing qualified equipment meant a direct reduction in your actual tax bill, not your taxable income. Your taxable income. Your final number, dollar for dollar off what you owed that year. A manufacturer in Michigan who bought a $10,000 press in 1971 reduced his tax bill by $700. Congress repealed the investment tax credit in 1986, the fifth major working-class protection removed in that single session. Number 6. Medical deductions. With a floor anyone could actually reach. Before 1982, medical expenses exceeding 1% of adjusted gross income were deductible. Today, that floor sits at 7.5%. A family earning $60,000 must spend $4,500 in medical costs before claiming a single dollar of relief. Most families never reach that number. Even in years when illness hits the hardest, the deduction exists. The floor ensures most people never touch it. Number 5. The personal exemption that recognized families is real. For most of American tax history, every household member reduced taxable income by a fixed personal exemption amount. A family of 5 in 1985 reduced their taxable income by over $20,000 simply by existing as a family together. The Tax Cuts and Jobs Act of 2017 eliminated the personal exemption for every American. Larger families with multiple children often came out behind in the exchange. The acknowledgement that feeding and housing people costs money was removed without ceremony or debate. Number 4. Student loan interest before income limits arrived. Before 1997, Americans paying interest on education loans deducted every dollar against taxable income. No ceiling, no phase-out, no income limit applied. A teacher paying down loans in 1993 deducted the full interest that year regardless of salary. Today, the deduction phases out above income thresholds that have never kept pace with actual loan balances. A nurse practitioner earning $80,000 annually receives no deduction at all, carrying the heaviest burden while receiving the least relief. Number 3. Self-employment retirement before employers became the gatekeepers. Before retirement savings rules were restructured through the 1970s and 1980s, a self-employed worker could establish retirement provisions and deduct contributions on terms comparable to large corporate plans without needing an employer to sponsor anything. What changed was not the existence of accounts. What changed was who controlled access to them. Workers between jobs, contract workers, and sole operators found their options narrowed progressively through 2 decades of quiet revision. Your grandfather built retirement security through paid-off property and disciplined savings, not because he preferred those methods, but because the tax code once gave him tools that were later taken from his children, one regulatory change at a time. Number 2. Small business dividend structures that kept profits in families. Before corporate tax reforms reshaped the landscape through the 1980s, small incorporated family businesses could distribute profits to working family members in ways that reduced the double taxation burden meaningfully. Money moved through working families. It paid for college tuitions, home improvements, and the next generation's start in life. The code rewarded distribution over accumulation, keeping earnings active inside households rather than sitting inside corporate structures. As successive reform acts eliminated these provisions, the effective tax burden on small family businesses increased while larger corporations with dedicated accounting teams found alternative structures without difficulty. But the gap between what large and small businesses actually paid widened. Quietly, consistently, without a single headline. Number 1. The deduction removed without anyone voting on it. This one never required an act of Congress. Through the 1970s, IRS administrative guidance permitted deductions for home-based work, informal business arrangements, and practical economic activity that millions of working Americans claimed legally year after year. Returns were accepted. No objections raised. No audits triggered. Then, the IRS changed its enforcement posture through internal guidance alone. No congressional vote. No public debate. No announcement in any newspaper anywhere. Millions stopped claiming, not because the law changed, because the threat did. That is the most important lesson this entire list carries. The code rewards those who understand it fully and quietly punishes those who rely only on what they are officially told. Your grandparents understood every provision available to them because someone at their kitchen table taught them. That tradition ended somewhere between their generation and yours. It does not have to stay ended. One provision from this list still exists in the current tax code. Most Americans have never claimed it, not because they do not qualify, but because nobody told them it was there. That is the next video. Subscribe, and it finds you. Your grandparents never missed a legal dollar. Neither should you.